What's up, everyone? Welcome to the Akuma Fund. Today, I'll be doing a review on the book Basic Economics by Thomas Sowell. And let's get started. So, Thomas Sowell is a world-renowned economist. He comes from the Chicago School of Economics, which descends from Milton Friedman. A lot of the guys who come out of that school are they're proponents of free market economics. A lot of the guys who directly underneath Milton Friedman have won Nobel Peace Prizes for economics. However, Milton Friedman also won the Nobel Peace Prize. However, Thomas Sowell hasn't. But Thomas Sowell is almost a pop icon now, and that's actually how I heard about him. I was learning about him through the Hoover Institution. And also because of my interest in capitalism and free market and especially free market capitalism. So I'm very well versed in other types of history, like political history, social history, technological history, and etc., or in the concepts in all those different branches. However, I have a huge lacking in economics, I feel, and this book was a great way to gap and understand the basics of economics, hence the name Basic Economics. Thank you. He breaks it down into about 4 parts. The first part is prices and markets. Second is industry and commerce. The third is work and pay, and then the fourth is time and risk. And very simply, in the beginning, he breaks down and defines what even economics is. Right? He defines economics as the allocation of scarce resources, which have alternative uses. Okay, and that might not make sense, but I'll do my best. So the first part is the allocation of scarce resources. Nothing in the world is infinite. You know, there's only a certain amount of energy or lights powering my computer. There's only a certain amount of cameras. There's only a certain amount of Sony cameras. There's only a certain amount of wood in the world. There's only a certain amount of people in the world. There's only a certain amount of things in this world, things that can be done in this world, because ultimately things are finite. I mean, right now we're only on this earth, the earth itself, so we only have what the earth is able to produce. Okay, so in essence, things are finite. Okay, the allocation of scarce resources, because resources are finite, which have alternative uses, and that comes in is because let's put it like this: wood, you can use wood to build a chair. You can use wood to build a house. You can use wood to build a boat. You can use wood to make a shelf. You can use wood to carve a statue. Wood has pretty much almost infinite amount of creative uses you can do with wood. And what is the most effective way and cost-effective way to have those resources allocated? Okay? And there's different ways to do this, and this is the first part of the book. The first way is through free market economics, okay? And the other way is through government. And there's other ways kind of in between, but in general, those are the main ways. You have people making decisions on how to do so based on prices and such, and you have the government saying, this is how much this thing should go for, this is how much this stuff should go here. Okay? And obviously, there can be a little bit of mixtures of the both. In this, it's pretty much clear and as economic fact that the closer you go to the free market side, the most cost-effective way resources will be made or allocated. Okay, for example, in the Soviet Union, they had obviously they had communism and socialism, and what I like about this book is it doesn't just say socialism bad, capitalism good. He explains why. Okay, he brings up examples. Okay, well, what about in the Soviet Union? Why did they have warehouses full of what was it, like beaver or something, some type of fur coat, and nobody wanted the fur coat, right? But for some reason the government said, okay, this fur coat, we want to have a whole bunch of these fur coats, but nobody wanted fur coats. Okay, or how in the Soviet Union there needed to be more workers to get the same amount of things done, or how you see what I'm saying? It's capitalism and free markets, and markets in general, not even free markets or markets in general, are better ways to allocate scarce resources than socialism, than the government is. Why? Because the government only has so much feedback. Okay, if a business, let's say I start a business, and my business is called the watch game. Okay, I sell watches. If I sell a watch that people don't like or that's not efficient or etc., what happens to me? I go out of business. Okay, but a government that owns, let's say, watch because there was a watch company called Vostok. It was owned by the Soviet Union government. Okay, um, they can produce watches, as much watches as the government says, and there's no feedback mechanism to say we don't want any more. And what happened was it got to the point where the only way something would be corrected in the government owned system is that things get so bad where you can't ignore it. However, in the world of business, I mean, trust me, listening to these conference calls, I mean, if you mess up, then you'll be hurt. But a government can continue to do so, and that's an interesting thing about prices and markets in the part one. It covers markets versus government-owned enterprises. It covers why prices are the way they are. I mean, why is this watch $200? Why is this lamp $30? Why is this computer $1,000? Because ultimately, that's what people are willing to pay for it. Right? That's what people are willing to pay for, because with increased demand, and let's say the supply says with increased demand and the higher the price can be, as long as the supply is less than to match the demand. Right? It's like the stock market. What makes the stock price go up? Someone is willing to buy that. Someone is in the market of buying that stock. Okay. What happens when the stock goes down? When more people are selling the stock than buying the stock. And eventually it hits a point, right, where people say, you know what? $20 for Apple stock? It was at $220. Now it's at $20. I mean, that's a buy for me, right? Along the way, there will always be someone who's willing to buy it for that price. So hence why the prices go down, and then whenever more people want to buy, hence the prices go up. It's basic economics, right? But there are times whenever it seems like, why is that? It's wrong, you know? Why, for example, with the housing boom, okay? With the housing boom, past presidents, I believe Clinton and I think Bush, George, I can't remember the names of the exact presidents or whatever, but they said, okay, we want more people to own homes. Okay, that was the government incentive saying to the banks, we want more people to own homes. So then the banks lowered their standards so that more people could get loans to buy homes. And what did that culminate in? It culminated in the 2008 housing crisis. Okay, when the government starts to tinker around with the economics to kind of to do stuff that changes the prices of things, basically the price is in equilibrium, right? It's saying on one side the buyer is saying I'm willing to buy it for this price. Okay, the seller is saying I'm willing to sell it at this price, and they agree. Okay, but when you mess with that, the equilibrium is changed. Okay, and that was a very interesting part of the book. Obviously, he has a bunch of numerous details about it. That was part one. Okay, part two, industry and commerce. It just talks about what a business is. Why are businesses good at economizing? What makes a business make money? What makes a business lose money? He talks about market and non-market economies, like a little bit of what I touched on earlier. I mean, obviously, as an investor, I really have to look. Okay, is this business making? First of all, is the business making money? Does the business have the potential to make money? Does this business have the potential to make more money? Does this business have the potential to lose more money? Okay, I mean, that's why we look at financial reports as investors, because we need to understand how these businesses work. Okay, how can we know if a business is profitable if we don't look at the financials? But here's an interesting thing. Do you want to know how a business is profitable versus not profitable? You just have to look what business is in business and what business is not, right? He makes this, is the businesses that exist today are the culmination of many things that went right for those businesses. And there's countless others that however things have gone wrong, okay? And it's because of this amazing thing that we have called profit and losses. Profit means someone is willing to buy something off you, meaning they like what you're offering them, versus losses mean that your business is losing money and people do not want to buy what you are selling. Okay, he talks about the economics of a big business. The economics of big business, meaning, people always say, oh, Walmart is bad, Amazon is bad, big business is bad, small businesses are better. Um, he doesn't even talk about that specifically. He kind of covers more of a um, for different types of industries and different types of businesses, it might be better to be bigger or better to be smaller. Some some points a bigger business has so much bureaucracy that they can't transition very quickly, but a newer competitor coming in who's smaller might be able to identify better opportunities more quickly and with less bureaucracy. And he also talks about how maybe for a restaurant, okay, like a restaurant with like waitresses and waiters and stuff, maybe the economy of scale there might be smaller than if it was selling books on the internet. Do you see where this is going? He talks about regulations, and how regulations, all sorts of anti-monopoly laws and regulations and such. He talks about how basically regulations are always put in place for a good reason. Okay, maybe it could be anything. It could be anything. Kids shouldn't work in mines, or etc. etc. Like there's always a good, like train crashes need to train industry need to be regulated because of train crashes. It always starts because of something of a positive impetus. But what happens is that those regulatory bodies end up in time being taken over by the industries that it was set up to regulate. Okay, and that's just a function of our democracy, and that's just a function of how these things work. And those regulatory bodies are then put onto new industries, and the old industries then try to regulate what is more than the outside the scope of that particular regulatory body. Okay, and there's a difference between these. Like the SEC, the SEC is not going around like regulating like stock market and all this stuff. It's mostly just like, oh, you guys are lying. This is then they come in and do something, right? But very different than I forgot. But there was like this, what is it? Like the train regulatory body I was mentioning earlier. They ended up expanding to truckers, and now trucking companies have to go and get a license from the train industry regulatory body, but the regulatory body has how do I say a incentive to allow less trucking people to enter into to get a license because it will increase the supply of trucking. Okay, so the existing trucking companies and the train companies have an incentive to limit the amount of new people who can get licenses to start a trucking company. I know this all sounds pretty complicated, but the book makes it very, very, very simple. And speaking of which, I have an example from my Washington's voter pamphlet. Okay, and I'm not arguing that regulations are bad or regulations are good. I'm just saying that it's just a cause and effect. In Washington right now, we have here we go. We have initiative. It's basically a regulatory or a tax against how do I say fossil fuel energy. Meaning it could be. Look, here's the argument for. Okay, we have a responsibility for future generations to pass on a healthier place to live. Initiative 1631 is a sensible step that puts a fee on large polluters like big oil companies, making them pay when they pollute our air and water, and invests in affordable clean energy and healthier communities. Right? Like that's a noble goal. Right? It's a noble goal. But here's the argument against. I-61's a deeply flawed, unfair energy tax would force Washington families, small businesses, and consumers to pay billions in higher costs for gasoline, electricity, heating, and natural gas, while exempting the state's largest polluters and providing little accountability for spending. Okay, so when you start to regulate and put taxes on all these things that people use on a daily basis, what happens is that the prices of these things will go up, right? And it's just one of those things where the government has a noble goal, but we don't know how this will play out, and it most likely will play out as in higher energy costs, hurting a lot of our drivers, and in terms of oil energy, and on the flip side, it could lead to increased renewable energy. Could lead to it probably is going to lead to more renewable energy, could lead to more electric vehicles. But what the difference is here is that the government is mandating, saying this is what we want to happen, versus the other is the market choosing on its own. And I'm a little concerned with that type of thing because, like in the economics book, where is there regulatory body being created? What am I going to have to pay for energy fees now? What am I going to have to pay for gas? Will this regulatory is this regulatory body going to expand? Is the tax going to include not just air pollutants? Is it going to include water pollutants? If you see where I'm going with this? If I own a shop where I'm doing something and I pollute the land, then it's just a lot of these regulations have noble intentions, but the outside effect is that they hinder the market, and the market is a very efficient way to do things. So basically, it makes things less efficient. But maybe it's, I'm not saying to vote for or against, but it's just an interesting example of how a real life thing. Okay, this thing on my voters pamphlet. Okay, I can understand it better because I have looked at the lens of basic economics. Okay. Another thing in the book, there's two other parts. There is the work and pay, so it talks about how it talks about minimum wage laws. It talks about unions. It talks about et cetera, et cetera. I mean, in the United States, obviously we have most people work in offices. Nobody really works, and factory workers are a rare thing. But for a Bangladeshi woman who's working in a sweatshop, right, it's obviously the pay is going to be much, 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 much lower, okay? And he brings up an interesting example of whenever people say, oh, sweatshops are bad, they should be paid more, etc., etc., it puts pressure on the companies to either raise the prices of the worker or to switch base and move somewhere else, okay? So let me give an example, let me elaborate a little bit. So that worker, let's say she's awesome. She's like, yeah, I get to be paid more. Okay, used to get paid at 75 cents. Now I get paid $1.50. But what happens is less people will then be hired. Okay, because the cost per worker has increased. We had to increase her hour per pay, her pay per hour. And what does that mean? It means less people in Bangladesh will be hired by that company. Okay, because maybe at 75 cents, they could have hired two people for the price of one. Okay, so therefore you have a woman instead who's forced to work in a different industry. Maybe she works as a farmer or a prostitute, or she has to work in a mine, or she works creating things and selling them on the street, right? Whenever you have to increase the price of labor, okay, whether it's by minimum wage, by unions, or by public pressure, it obviously the people who work in the industry will get paid more, but also on the flip side, it's that less people will be hired. Okay, so it's an interesting thing, right? It's you think that these things would help, right? But they also hurt in the sense that it's just there's a cause and effect, and what is initially put out there is much, much more complicated. For example, I remember a few years ago I was thinking, oh, I'll shop at Goodwill so I don't have to buy things from people who work in a sweatshop. But if I shop at Goodwill and I don't buy stuff that was made in a sweatshop, then those workers won't have a job, right? It's so interesting how many things that are meant to help people end up hurting them. In part 4, time and risk, and this is probably the most relevant to me. It talks about investment, stocks, bonds, insurance, and the special problems of time and risk, and it's super interesting. So a worker, okay, I mean, almost everybody has a job. Most people have a job. Okay, I have a job. I own a business. I have a job, and I'm an investor. Okay, so let me give an example. As a worker, right, I get paid for work I do up front. Here's your cash. Here's your money. You know, so I don't have to take that much risk because I know that as long as I work, I'm gonna get paid. But as a business owner, If nobody wants to watch the videos on Akuma Fund or Akuma's Arsenal, no one wants to click the links and buy the books. And by the way, I'm going to have a link in the description if you want to purchase Basic Economics. It's an excellent book, one of my favorites of all time. It's very thick, very easy to understand, but check the link in the description if you want to purchase the book from Amazon. Um, but if no one does those types of things, my business is not making me money. Okay, I can put a million hours in, but if no one wants to click on that ad, or no one wants to watch the video, or nobody wants to do such and such, therefore all that time was for naught. But if I instead put that time into a job, I'm guaranteed income. Okay, but on the flip side, my reward could be higher. Maybe I make 150 videos like on my horological channel, and to this day it makes me money. I don't have to do anything for it. So therefore, my time horizon was much farther. I was thinking years out, versus when I'm a worker and I work for my job as a video editor, I'm thinking a week out. Pay me now, right? And I actually got 10% stake in that company, so it's a little bit different. But those are the different aspects. And as an investor, you're not, like, when I invest in Atlantic Yield, I'm not thinking, oh, I'm going to sell the stock in 6 months. I'm thinking I'm going to hold the stock for 30 years. So my time horizon is much farther as a business owner or as an investor than as a worker. And hence, you take on more risk, and therefore your reward is potentially higher. And therefore, as a worker, you are paid less than what you are obviously worth. A lot of the book is really quite excellent. Thomas Sowell really did a great job teaching me, someone who's not very well versed in economics, what economics is, what are some causes and effect on economics, what is the most efficient way to allocate resources that have alternative uses. Very excellent book. I recommend it to everybody who is interested in business, in politics, in investing, in learning, and also in yeah, mostly, and obviously economics. So thank you very much for watching. I had a great time reading the book. Thank you, Tom Sowell, for making this book. I will probably be checking out the other books by him in the future, and also maybe reading some Milton Friedman, maybe even reading some other types of stuff to learn more about economics. This book has helped me very much understand how regulations hurt the consumer, but also might be good for me as an investor. Just interesting how government interacting with the economy works. It's a very interesting topic. It's very deep, and this was a great introduction. Thank you very much for watching. Akuma out.